Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by. Recent comments from Jeff Gundlach from Double Line Capital. He's the CEO and the Chief Investment Officer. He's talking about some strange things that have been happening when equities sell off related to the dollar and related to the bond market in the United States. It caught my attention because it's very similar to what David Rogers Webb says, but I want to go ahead and make sure that they were saying the same thing, because recently I've gotten some feedback from someone in my life who says, yeah, but David Rogers Webb is just one guy. But Jeffrey Gundlach is known as the Bond King. So let's take a listen and see if we can shed any more light on the possible validity of what David Rogers Webb argues.
Considering the fact that you've talked about how the U.S. is going to go bankrupt and how it's on an unsustainable fiscal path, are we seeing that priced in, or is there still a reckoning to come?
Well, it's certainly behaving differently than it was for the last 4 decades. I mean, what we've seen is in the last 15 years, there's been a number of corrections on the S&P 500. And in every single one of them, when the S&P goes down more than 10%, the dollar index, the trade-weighted dollar index goes up. This time, the dollar went down when the S&P 500 went down almost 20%. That's strange. Things are behaving differently.
Now, historically, whenever there had been a panic or a big down day in equities, you would see a spike in the dollar and a big drop in bond yields. Now, why did that happen? Because the money, because if you imagine there are entities that are levered that own equities, that have levered up holding their positions. And so when a crisis is developing, or even one panicky day, the funds raised from selling the equities goes where? Goes to pay down the margin debt, the leverage. And in order to do that, because the dollar has been the funding source, all the leverage globally is in dollars, the money raised by selling equities would buy dollars. Now, not to own dollars, to pay down dollar-denominated debt. So you would see equities sell off, bond yields would fall, because money would go into paying down debt and seek safety in bonds. So you would see the dollar spike in order to get dollars. This is a global phenomenon. The dollar spike to get dollars to pay down the dollar-denominated borrowings, and also to seek safety in bonds. That did not happen, and that was unprecedented.
15 years, there's been a number of corrections on the S&P 500. And in every single one of them, when the S&P goes down more than 10%, the dollar index, the trade-weighted dollar index goes up. This time, the dollar went down when the S&P 500 went down almost 20%. That's strange. Things are behaving differently.
So then in March, there then was a day where all equity markets, the U.S. had down days, but then it spread to all indices. And that's what we talked about at that point, that now it had broadened into all equity markets falling globally. And the very bizarre thing was the dollar fell and bond yields went up, which is unprecedented.
Okay, so here Jeff is saying that when the Fed cuts interest rates, he says usually all the rates go down together. And when he says that the 10-year goes up, he's talking about the price. He's saying the price of the bonds go up. Bond prices and bond rates move opposite of one another, or inversely. Okay, so when he's saying Fed cuts rates, rates fall across the yield curve. I'll put a picture of that up here. And we would expect that bond prices would go up. But that's not what happened. That's not what's been happening.
Usually when the Fed starts cutting interest rates, rates across the yield curve go down. The 10-year Treasury almost always goes up immediately following the first Fed rate cut, and then it keeps rallying for a while. This time, the 10-year yield went up. and the yield curve is steepening. So I think what we have is a recognition that the interest expense for the United States is untenable. And there's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. It's not responding to lower interest rates. It's not really responding to an inflation rate, which is now 2.5%. Probably going to go higher on the inflation rate because the ones that are rolling off from a year ago, I mean, the cumulative, I think, headline CPI that came out today, it was 0.18, but the one that was rolling off, I think, was 0.1. And if you do the next 2 months, those 3 months together, that quarter, the cumulative rise from a year ago was 0.1. So we're likely seeing the low point in near-term inflation. So yeah, I think the reckoning is coming, is that we have to somehow figure out how we're going to deal with $37 trillion. I mean, we're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that.
So this is where the two guys really diverge when it comes to this creative thinking solution that Jeff is suggesting. Jeff will go on to say, look, the United States cannot handle 6% on the long bond. So he said when it gets there, he thinks the best solution is going to be quantitative easing, meaning the government will start buying U.S. Treasury bonds, long-dated U.S. Treasury bonds. David has a very different solution. David thinks that they're actually going to come for people's retirement funds if you have some kind of crisis. Let's hear what he has to say.
That has never happened before, and no one paid attention to it. No one talked about it other than us, and that was the tip-off. Now, what is it? It's a tip-off about what? That a decision has been made to disappear liquidity on a vast scale from the global financial system.
So the previous group talked about capital flows, and one of the reasons that the U.S. is underperforming at this point is so much money came into the United States since, say, 2015 or so, or 2005, and there was a net investment position. Foreigners were investing more in the U.S. than the U.S. was investing outside the country, to the tune of $3 trillion. That was about 15, 17 years ago. It's now over $25 trillion is the net investment position, and the dollar is falling. So it's not inconceivable that some of that $25 trillion that came in over just a couple of, not even 2 decades, could go out.
That a decision has been made to disappear liquidity on a vast scale from the global financial system.
And so this is a moment where finally you have the setup where non-U.S. investment, even if you're a dollar-based investor, you should be thinking about increasing your allocations to non-dollar investments. And it's already working. It's already working.
So there's so much to unpack there. I want to talk about the idea that there could be this 25 trillion or some of it that moves
Say
away from the
5
U.S.
trillion.
Right, exactly.
Yeah.
Whatever it is,
Yeah.
3 trillion. You're getting trillions of dollars moving out of U.S. assets.
Yeah.
How high or what kind of behavior do you have to see in the 30-year bond to like it again, given the fact that you've been very vocal
I've been
about
thinking
shorting
about
it?
this for a long time, and I've come to the idea that as the Fed eases, and when the economy really does weaken more, the Treasury will continue to go up at the long end. And so for now, we're very uninvolved in the long-term Treasury bond. But there will come a moment where you have to pivot, because there's going to be a response. And I've got many ideas of what that response might be, but one of the leading candidates would be quantitative easing. So you get to a point where the rate is so uncomfortably high. What is that number? I'm going to guess 6%, where they say, this is going to be something that we're going to be running a $5 trillion budget deficit with all this bond issuance when we go into a recession. And so they'll pivot. I believe this is a sensible idea. There's other ideas too, but the leading candidate is they will announce quantitative easing on buying long-term treasuries. And when they do, you have to very quickly, and hopefully you do it the day before they announce it. But we don't have access to the day before stuff. That's for the primary broker dealers. But you would need to buy long-term treasuries as much as you possibly could, because when that gets announced, it'll be just like when they announced buying corporate bonds in COVID, where all of a sudden the corporate bond market went from down 20 points to right back to where it started in just a matter of a few days. You could get a 20-point rally on the long bond if they announced that they're buying the long bond, because that would be a 100 basis point drop.
You said that.
Okay, so let's kind of put this all together. I would say in general, you have two guys that are generally agreeing on the big parts. If we look back 40 years back or something like that, that's what Jeff Gundlach talks about. And David would go back. He doesn't define the time frame, but during his career, in his understanding, that whenever you have a stock market decline, S&P 500 or whatever, any big panic, that what happens? Well, people sell. That money goes into dollars. And they both agree when those things happen, the dollar goes up, typically, historically and typically. Dollar goes up. Once people have money in dollars, what do? They put it in something safe. So they buy bonds, U.S. Treasury bonds. Okay. Well, if we think supply and demand, if you have a whole bunch of people coming in and buying, price goes up and the yields drop. Well, these guys are saying that's not what's been happening. You've had these big shocks in the stock market. The dollar has not gone up. It's gone down. Okay, so that's one weird thing. Related to the bond market, you see all that money flowing in. It's what you see historically. Has that been happening recently? They would say no. Why would they say no? They would say no because if you have a whole bunch of money flowing into the bond market, it's going to push prices up, right? A whole bunch of buyers are going to bid the price up. Prices are going to go up, and yields should drop. Because as we talked about and as we showed on those graphs, when prices go up, interest rates do the opposite, okay? Well, they're saying that you had a big shock in equities. Bond prices did not go up like they were supposed to, and bond yields did not come down. So their assessment is the same. Their solution is different. Jeff is saying, well, there's a lot of different solutions. He's using words like creative thinking. He thinks that the best option is that the U.S. government will buy long-dated treasury bonds. And that if they flood in, then they're going to jack the price up. And so you want to get in ahead of them and make 20% on those bonds. Well, David says something different. David says it's not money leaving the equity markets from foreign investors. David is actually arguing that. So they're saying the same thing, but their reasons are different. David is saying this money is actually being like evaporated, like it was created artificially, so it could be destroyed artificially. For sure, I would say that Jeff is not able to say that as a manager of Double Line Capital, chief investment officer. So he gives us a different solution. He says, well, possibly, he doesn't really give us a solution, but he says what we could imagine is that this $25 trillion of foreign investment that's come into the United States equity markets or stock market is leaving. Look, I mean, either way, what can we conclude, no matter which person is right? Well, they're both saying that money is leaving the equity market, the stock market. So S&P 500 is at 6,000 today. Neither guy, it seems like, would be telling you to, stay in U.S. assets. So Jeff is saying move into emerging markets like India or something, he says later in this interview, actually, and just stick it there for a long time. David says, get out completely. So Jeff is literally saying get out of dollar-denominated assets, and David's saying the same thing. He's saying, yeah, get all your money out except what you can afford to lose. And if you follow his trajectory, you're going to buy a farm and store up a year's worth of food and make friends and maybe physical assets, property, land, maybe small businesses, maybe gold and silver, maybe crypto. I don't know, but David doesn't usually talk a lot about crypto. But the shocking thing is that these are very, very similar analyses done by these two gentlemen, and Jeff doesn't show us all of his cards. He gives us what he thinks is the best optimal solution, which is sort of weird. I mean, he doesn't go on to talk about what kind of inflation would you see. He's a very smart guy, definitely. So I wish he would have talked more, but to me that doesn't make a lot of sense, because where's that money going to come from, right? A lot of people would object and say you can't print your way out of like a debt crisis, because you're just going to make the matter worse. You're going to print more money, create more debt. As the currency becomes worth less and less, foreigners do not want to buy these US-based bonds unless they have like a really high return, high enough to compensate the falling price of the dollar. And so they don't want to hold dollar-denominated debt unless it can, give them inflation that's lost plus some extra, right? So if inflation is 5% and they want a 6% return on their money, they need 5. 5 is taken up by the inflation, so they need to at least get that just to be even, and then they need their actual positive return, 6. 5 plus 6, they need 11%. You can't have bonds that pay 11%, obviously, not with $37 trillion debt. So this is where I think most of the questions I would expect would be coming to Jeff Gundlach and say that's not going to work. David's solution is, well, they got to start taking it from people, capital controls, or whatever you want to call it. David calls it the great taking. Anyway, thanks for watching.